Very common investor question.
Questions that need answering.
Should I be using cash or my qualified retirement plan money to invest in real estate that gives us tax benefits and depreciation? Or when I use my different types of money for different types of investments, like my cryptocurrency or high yielding venture capital types of deals, I'm also going to be going into higher level using cash for getting cash flow today. And I'm going to coin the term as like legacy money for those QRP into the future. Now, of course, before we get going, we're talking about self-directed IRAs and solo 401ks here, not the garden variety that you'll see with your typical broker that you're with. Those guys, they want to keep the money locked in with them. And that's why on this channel, we talk a lot about investing outside of Wall Street. This is the world of alternative investments. Let's get into the answer here. With real estate, especially if you're on the equity side, you have a share of the depreciation. And that's one of the big reasons why we like real estate so much. When you invest cash, you get those depreciation passive losses on your personal taxes. But when you're investing in something outside of real estate, call it a venture capital or life settlement, stocks, bond, mutual funds, another one would be like crypto. No tax benefits in any of these types of things. Ideally, you want to use a self-directed IRA, a Roth IRA, Solo 401K, or QRPs or qualified retirement plan money. There are advantages of using these types of accounts, especially for these types of asset classes. So make sure you use the right vehicles for the right type of investment. The other thing, it's not 100% absolute, but just another consideration is use these QRP accounts for high volatility or more asymmetric type of investments. Again, the good example that keeps coming up is like cryptocurrencies, whereas investments that yield cash flow are typically not as asymmetric. These are like apartment deals, value add deals, and deals that obviously give them tax benefits are like the two things I'm pointing out here. So even if an investor only does like real estate projects, for example, what they want to do is they want to look at their portfolio and ask themselves, which are the more asymmetric type of projects here? And just in the real estate world, a development will be more on the asymmetric side. So they may earmark if they have 20% of their money, the color of QRP money, specifically in a self-directed Roth IRA. They may opt to invest out of that vehicle than their cash. Because another thing is, especially developments, they're more of a long-term play. There's no cash flow in the interim. And that way you can have that money compound within that tax sheltered QRP. There are tax benefits in developments because you're an equity holder, but you don't get that front loaded. You have to wait till the asset is put into service, makes $1 of income, and then you can depreciate the asset, which typically happens around the second or third year in. The other thing that people will use in their QRPs is more on the speculative side. I think that it's a similar term as asymmetric, and it has the ability to just absolutely maybe 2x, 4x, 5x plus. And it's nice to have it in your QRP. And if you want a good example of this, Peter Thiel, famous guy, he started PayPal and he put his self-directed IRA money, I think it was Roth actually, and that thing grew like many multiples. And of course, everybody's all pissed off because it's like, how did this guy have millions and millions of dollars in his Roth IRA? Of course, that's when you really look at all the politicians and all these. Mitt Romney has like billions of dollars in his Roth IRA. These are the types of strategies that these people are doing.
I fear you're underestimating the sneakiness, sir.
The bucket theory, where fill up your cash flow today bucket with $15,000 to $50,000 a monthly cash flow first, then go fill up these self-directed IRAs, Roths, Solo 401Ks, defined benefit plans, or QRPs after. Unfortunately, we all have it wrong where we fill up the second bucket first, and then we never get to retirement or financial freedom, which is the first bucket. This is that whole idea reimagined. We'll take a look at on this left side, right? So in this chart, your age as it expands, basically your core capital, or another way of saying it is your passive cash flow number is steadily going down, right? Because you're getting older, for typically the consuming years, especially if you have kids, you're paying for college, that kind of is the peak of it. Then it just goes down from there as you find much more simpler life and the money that you have expands on the legacy capital side. So you can see this as the core capital. Think of that as bucket one. And then as you expand, that bucket one spills over to the legacy because you don't really need it. You can't really spend it. Here's another way of putting it, hierarchy of objectives. The lifestyle spending, that's that core capital down there. Think of that as your burn rate. In the coaching calls, when I ask people like, hey, how much does your family spend? For a lot of you folks, I would say $8,000 to $15,000 a month is typically what you guys burn. So everything on top of that is what you invest in any investments. But this is more like once you have a nest egg of $2-3 million net worth and above, you need to start to think in terms of what is it that I really need? What kind of a cash flow stream do I really need? $15,000? All right, great. Everything else is gravy on top of it or this light blue color, and it's going to go to them. Now, I think most people, they want to give their children and grandchildren money. I would probably argue giving them more than $1 million per person might be more of a disadvantage than anything. Specifically speaking, you spoil them at that point. But say you gave them $2 million each. After that, it's really surplus capital here. And this is where some people, if they have enough, they'll start new ventures. They'll put multiple 6-7 figures to charity. And this is your wine budget right here. But you want to start to put this light color blue into this second category of vehicle investments, which is the yellow bucket, which is these QRPs. If you follow what I'm putting here, it makes sense to fill up these QRPs after you get your oxygen mask on here and have 15 plus of monthly cash flow first, because you invest cash, you get the tax benefits of investing the cash now to lower and manipulate your adjusted gross income how you want. Once you hit that threshold, call it typically $3-4 million net worth, that's when you start to fill up that second bucket and go after this other things here.
Wow, that is...
To sum that one all up, again, leveraging the non-tax advantage funds or cash, investing that stuff first in scenarios where you can directly benefit from the losses and the deductions. Then secondly, after you've placed that money, you utilize the funds from IRAs or other tax advantage accounts, QRPs, for investments that may not benefit as much from immediate tax breaks. Another way to think about it is you have two colors of money. When I was a city engineer, we would get different funding sources. We would have general fund money and we would have utility money that we had to use and pipes and sewer, etc., where the general fund money was a lot more useful everywhere, sidewalks, streets, etc. So two colors of money. And just like here where you have two colors of money, where you have your QRP money and your cash, the strategy when I was with the city as a city engineer is to use the general fund money where I could, but use up that specific money from the utility stuff first. So in a way, and I guess in this analogy, what I'm saying is that utility money that I could only use on utilities, I used to try to burn it up first, where the general fund money, it was a little bit more flexible. So I held that second. Maybe think of it more like a wild card if you're playing like a card game.
We have just one trump card left, Robin.
Your IRA money, try and use that up first or get it out of there. I pulled the goalie on my IRA funds and Roth IRA funds early. So that may be another option for you. That really gets more technical and everybody's got their own specific type of situation. You may be in a high tax bracket. If you are in a high tax bracket, you may want to combo it with real estate professional status. Or if you're selling off other properties or assets, that's what the tax PAL fund is to get the Section 179 passive losses there. These are some of the hacks that you could do, but I think it's important for you to understand that some of you guys have a whole lot of money in your IRAs because that's what we were all taught and misled to do. So you may have $2 million in your IRAs, 401Ks, and barely anything in your cash pocket other than the $500,000 locked up in equity through a HELOC. So this is where, if you've seen talks in the past, you have two places to go get the cash. And once you burn through the HELOC money, then you've got to take money from the IRAs. And depending on where your net worth is, you may not have that critical mass amount, right? Especially if you're under $2 million net worth, then you may have to start deploying the QRP accounts to cash. to get it effectively moved that way. So you get the tax benefits that way because your income is high. Again, so many permutations, commutations. I would suggest checking out the coaching calls because we just run through so many different scenarios there for the cheap, easy, free option. If you guys want to come on these future podcasts anonymously, we can feature you there and you can get some free advice. Unfortunately, what most people do is they say, well, I had so much money in my 401k and I've done it so long that I'm just going to keep doing the status quo. And I'm like, all right, whatever. Cool, man.
Never give up.
Unless you get around other high net worth accredited investors doing this stuff, you don't see the power of it, especially when it starts to go 4, 5, 7, 10 years into the future.